We're back with another video in the advanced guide. Today we're going to be talking about RSI, or Relative Strength Index. This is another momentum-based indicator. As you can see, it's right here. Let me go ahead and exit out and show y'all. Click Indicators, RSI, Relative Strength Index. There you go. So the average period number is 14. That's just the default setting. You can lower the number if you want it to be more sensitive, and that's for a day trader or a swing trader, or somebody who makes multiple trades within the week on lower time periods. You can increase the number if you want it to be desensitized. That's for the people that are like longer term, monthly, weekly, yearly traders and things like that. So the values for RSI, these go from 0 to 100. And 50 is that neutral point. Now, there's a few things that the RSI can indicate. The first thing is overbought and oversold points, right? So basically, when the RSI crosses this 70, this line here is 70, this line here is 30. When it crosses the 70 line, that indicates overbought. Like a lot of people are purchasing the whatever coin or currency or whatever the case is. A lot of people are purchasing. When it drops below the 30, that's the same case, except it's oversold. So when it's overbought, that can tell you that okay, so there's going to be a lot of selling pressure coming up. It's maybe reaching its maximum price or relatively maximum price, and there's going to be a lot of selling power. So it's probably good to get out before the price drops. Or when it's oversold, there's going to be a lot of buying power coming up, or a lot of buying pressure coming up, and the price is probably reaching lower points of, relatively low points or lower points on the chart. So the best time to use this overbought and oversold indicator is on stagnant price ranges, sideways price ranges. So for example, here you can see that the price ranges between this relative maximum, and you can see that it gets very close to whatever this resistance would be up here, and the price several times stays near this relative support. So it bounces in between this area, right? That's the best time to use the overbought and oversold. So when you see a price action like this, you can go ahead and look at the RSI and see that okay, so it starts somewhere around here, right? In this overbought area. So the price drops, and then it starts to bounce around, as you can see, and it moves. Okay, it's pretty stagnant. Then it comes and hits an oversold point, right? So that lets you know that either this point here, or maybe in the next few points above it, will be the maximum, the relative maximum in that area, and the price will reverse or should reverse. And as you can see, it hits this overbought area here, consolidates a little bit, comes close to touching it again, and then the price drops. It goes on its opposite trend, right? Now, you can also use the overbought and oversold indicator on strong trends, strong upward or strong downward trends, but instead of it showing price reversal, it'll show consolidation. It'll just show that the price will bounce back. Like if it's in an uptrend, it hits the overbought area, it'll bounce back and probably continue that trend, or bounce back and stay in a little area and probably continue to follow that trend. For example, from here to about here, we can say that's a strong uptrend, right? So let's start here and look at the RSI. The next time it goes above and hits that overbought area is right here. Slight little consolidation, or actually it's this whole area here. So this whole area is going to be consolidated in this area. You see it's going to go up here, and the price is going to revert and bounce around in the same spot. Right? Hit another overbought area, wants to consolidate, goes back up, hits another overbought area right here, consolidation. So on strong trends, the overbought and oversold shows consolidation. On stagnant trends, sideways prices, that's when it shows the price reversal. Another good indication that the RSI shows is divergence. We talked about this in other videos, but once again, divergence is basically when the price action or trend, the trend that the price is on, differs or diverges with the trend of whatever indicator you're using. So in this same area, from here to here, price here, RSI here, you can see that the price is on its uptrend, but the RSI is on its downtrend. That is divergence. So when you see the price on the uptrend and the RSI on the downtrend, that's a bearish divergence or a bullish divergence about to show a bearish trend reversal, and then we see the trend reversal. Vice versa would be if it were to be the price be on a downward trend, RSI on an upward trend, it would show a bearish trend reversal. A bullish trend reversal. The price would go upwards. Let's see if I can find one. So for example here, this is a smaller one, not as big as a reversal as the last one I just showed, but you see the downtrend for the price and the uptrend for the RSI, right? And then what happens? A reversal of price. And then you can even look further into the future and see, this has some consolidation right here, and then the continuation of that upward trend. But yeah, that's the divergence. And one more thing, I count these two as very similar indicators, but this indicator called failure swings, it is basically the same as divergence, except you don't look at the price, right? So here you can see that the price comes, or the RSI comes and breaks this oversold area, comes back, plays around, comes back and touches it, breaks it a little bit here. So basically if it does that, then you should look at that last resistance. And when the RSI breaks that resistance is when the trend reverses. And at this exact point, you can follow it up. That exact point where it met the same resistance, that's when the trend breakout started, right? Same here. So we have it break here and come touch again. The last support was right here. So when it touches the support right here, we can go up and follow that line. That's this point right here. That's where that new trend starts. So you can see those two as the same or very similar, the failure swing and divergence, except divergence, you look at price action also. Failure swing is just RSI. But yeah, those are the three indicators that you'll be dealing with the RSI. Once again, let's go over it. Overbought, oversold. That's when it crosses the overbought or oversold points on the RSI. If the price action is stagnant and flat like this, then it's going to show trend reversals. If the price has an uptrend or a downtrend, it's going to show pullbacks or consolidation. The divergence, you want to watch for the price action to be the opposite of the RSI. The trend of the price action to be the opposite of the RSI. It will show a reversal of the price. And then the failure swings, you just want to watch the RSI and see when it breaks that overbought or oversold point, comes back, meets a resistance somewhere, and tries to come back and touch the overbought or oversold point. And whenever the RSI goes past that last support or resistance, that's that buy or sell or that indicator that the trend has reversed or will reverse. So with those three things, and I would also recommend, I say this every time, do not only use one indicator, use other indicators and other methods to confirm your predictions, and you will be all right. Thanks for watching. Y'all tune in for the next videos.